Have you seen those videos of those top 3, 4, 5 ETFs to buy? Even though most ETFs have had a great run so far, I believe that 2025 and the following years will be just as great, if not better. Here's why I believe this. Number one, Trump won the elections. Number two, the recession possibilities are already priced in the market. Number three, the Fed might actually get pressures to start lowering rates, even though inflation might not be where they expected it to be. And fourth and final, I believe that you should dollar cost average anyways. If you're wondering what is the best ETF or the best combination of ETFs, stick around and we're going to discuss the top 10 ETFs and why they might make sense for you and how to approach investing into ETFs that align with your goals. But before we actually get into the investing and talking about each ETF, let's discuss what even are ETFs and why they are so recommended by every investor or advisor and why they might make sense for you. ETF stands for Exchange Traded Fund. And you could buy an ETF like you will buy any other individual stock in any exchange. But usually ETFs hold a basket of different individual stocks or bonds or different type of assets, and once you make a single investment, you are buying into all of these different assets and types of investments, and with a single investment you gain that kind of diversification. So in basic terms, buying into one ETF, you are basically buying into multiple different assets, asset classes, or even different companies. Each ETF is created with a specific purpose, and not all ETFs give you the same kind or level of diversification. In fact, depending on the ETF that you buy, you might be exposed to the risk of specific assets, companies, or sectors of the market. So let's get into the top ETFs and the ones that I'm buying for 2025. The first ETF that I'm buying is VOO. VOO tracks the S&P 500. This ETF is very popular and usually recommended by many investors and advisors because it has a great track record and because it actually tracks the S&P 500. So if and when the S&P 500 goes up, this ETF also goes up. But when it goes down, it also goes down in value. This ETF was created in 2010 by Vanguard. In 2023, it returned 26.32% in gains. 2024 is tracking to provide about 30% in gains. But also keep in mind that this ETF only tracks the S&P 500, which is not a bad thing, but at the end of the day, it doesn't really give you the diversification that you might want. That's why there are so many other ETFs that you can include in your investments. By including other ETFs, you gain diversification and potential for growth. The more diversified you are, the lower the risk you are exposed to. But it also exposes you to growth that you wouldn't get if you are only tracking the S&P 500. Today, I'm going to be buying some of those ETFs that kind of complement VOO and give you that kind of diversification that you might want to lower your risk and expose yourself to growth. So for that, the next ETF that I'm buying for 2025 is VUG. VUG tracks large US companies that have higher growth potential than the average market. This might sound like a super great deal and that you should only invest your money into that ETF alone, but keep in mind, even larger US companies that are growing fast have a chance to come down in value, exposing yourself and the whole portfolio to go down when things don't go perfect in the market. This ETF was created in 2004 by Vanguard. In 2023, it returned 46.83%, which is great. In 2024, it is tracking to return about 32% in gains. The next ETF that I am buying for 2025 is VTI. VTI tracks the performance of basically all US stock market. It includes large, mid, small, and micro cap companies. This ETF is a great investment, and most of the time, it provides the most diversified investment that you can make when it comes to risk. But the downside to this investment is that it doesn't really give you the growth potential that you might want for your portfolio, especially if you're starting out. This ETF could be a great option for someone that is in retirement or closer to retirement and wants a portion of their portfolio to be still exposed to the market without really taking on the risk that entails being invested in the market. So I am investing $1,000 into this ETF as well. This ETF was created in 2001 by Vanguard. In 2023, this ETF returned 26.05% in gains. 2024 is tracking to return just about 28% in gains, which is fantastic. Now, the next ETF that I'm buying for 2025 is VTV. VTV aims to track the performance of large US stock only. This ETF usually offers stability over the long run, but has lower returns most of the time. One added bonus to VTV is that it pays out a dividend, depending on the dividends that are paid out by the companies that make up this ETF. This ETF could be a great way to balance your portfolio if you're looking to diversify into bigger, more value-based US companies. VTV was created in 2004 by Vanguard. In 2023, this ETF returned 9.32% in gains. 2024 is tracking to return just about 24% in gains, which is also very nice. Look, I'm just giving you a quick breakdown of what these ETFs are and what they represent. But if you need help deciding which will make sense for you, keep watching and I will give you my recommendations and show you what I'm doing and why. The next ETF that I'm buying for 2025 is QQQ. This ETF tracks the NASDAQ top 100 companies. It is heavily focused on tech companies. This usually means swings for the up and down. You could see some very nice gains for some time and some very scary drops other times. So even though I am investing $1,000 into this ETF, I would caution others to be more hesitant when investing a big portion of their portfolio into QQQ. This ETF was created in 1999, one of the oldest ones that we have here, by Invesco. In 2023, it returned 54.85% in gains. 2024, it is tracking to return about 26% in gains. The next ETF that I'm buying is SCHD. SCHD tracks the performance of the Dow Jones US Dividend 100 Index. This ETF is focused on companies that pay out a dividend, and it is a very popular option for people looking to get some income from their investments, like people in retirement. This ETF in general offers lower growth potential when compared to others, but it offers a more stable income and usually less swings in prices. This ETF has been part of my portfolio for a while. You will have to pay taxes on those dividends throughout the year, every year, unless you hold this investment in a Roth account. But that's a topic for a different video. Let me know in the comments below if you want to understand better what I mean by this. This ETF was created in 2011 by Schwab's. In 2023 alone, it returned 4.57% in gains. 2024 is tracking to be a better year, returning about 20% in gains, which is very nice for a high dividend paying ETF. The next ETF that I am buying is SCHG. SCHG is made up of large, fast-growing US stocks. Companies like Apple, Nvidia, Microsoft, Meta, Tesla, and Google. There is a massive overlap between SCHG and QQQ. Just about 60% of these ETFs are shared in common. So just like QQQ, this ETF is focused on growth and heavily invested in technology companies as well. This ETF was created in 2009 by Schwab's. In 2023, it returned 50.1% in gains, about the same as QQQ. In 2024, it is tracking to return just about 35%, just a little bit more than QQQ. The next ETF that I am buying for 2025 is SCHB. This ETF is very similar to VTI from Vanguard, which basically tracks the whole market, but this ETF focuses on the top 2,500 largest company in the US that are traded in the stock market. This ETF is usually a good representation of the US market as a whole and usually provides a very stable growth and performance over the long run. The ETF was created in 2009 by Schwab's. In 2023, it returned 26.17% in gains, and 2024 is tracking to return just about 28% in gains. The next one might be a little confusing or out of the ordinary, but I am investing $1,000 for next year into SCHF. This ETF tracks developed international stocks. So it tracks international markets outside of the US. Investors looking to diversify into international stocks and gain some exposure to markets outside of the US should look into this ETF. I would not suggest investing more than 10% of anybody's portfolio into international stocks unless you actually know what you're doing. I'm not saying that they are bad investments. In fact, some years, international markets outperform the US and vice versa. But keep in mind that regulations are different and markets do behave differently outside of the US. unless you're familiar with what you're doing, limit your exposure by limiting how much you are investing into international markets. This ETF holds great companies like Novo, Toyota, Shell, Samsung. The ETF was created in 2009 by Schwab's. In 2023, it returned 18.34% in gains. 2024 is tracking to be a bit lower, but it's still tracking to return 6.5% in gains. The last ETF on the list is a very popular ETF. But before we talk about this ETF and why it is so popular, let me tell you what I think so far and what my recommendations are for anyone that is really looking into starting investing for the long term into ETFs. Many of these ETFs have a lot or some overlap. Investing into two different investments doesn't really give you the exposure that you are maybe thinking that you're getting or the growth potential that you're already looking for. Many times you're not really gaining any diversification benefits by investing into too many ETFs. That's why many investors or advisors will recommend a portfolio of 3 to 5 ETFs. With those, you should gain enough diversification in your portfolio and have enough exposure to growth and lower risk and still be on track to hit your goals. Now, let's talk about the last ETF. And after, I will give you my recommendation and what I suggest people do and how they should break down their investment portfolio to really gain the most out of it. Diversification, exposure to risk, and exposure to growth. If you're liking this video so far, please like, subscribe, comment below, really helps the channel. The last ETF that I am investing $1,000 for next year is JEPI. J-E-P-I. JEPI or JEPI has become a very popular and talked about ETF since it was launched. It is still very new, but it's very popular as it is. The ETF focuses on paying out dividends and has had a decent growth since it was created. JEPI tracks the S&P 500 and uses a combination of different tools that allows it to generate revenue, and they pass that revenue to their investors as dividends. If you're looking for an ETF that pays out the most frequent and close to being the highest, then JEPI is the one that you're looking for. Just make sure that this is the one that actually makes sense for you and aligns with your goals. This ETF is very new and there's not a whole lot of record to go back and track how the ETF will perform when the market is not doing so great. This ETF has basically only existed when the market is doing great. So we have no clue how the ETF will perform once or when the market is not doing great. One thing to keep in mind is that this is a managed ETF and the ETF was created by JP Morgan. I'm not saying to blindly trust a bank, but when it comes to Wall Street, JP Morgan has a reputation of being an authority. Again, this ETF has only been around during times where the market is doing great. So we don't know how it's gonna react or perform when the market takes a turn to the downside. The ETF was created in 2020 by JP Morgan. In 2023, it returned 9.81% in gains, which is very good for a high dividend paying ETF. 2024 is tracking to be an even better year by returning 18%, which again is very good for a high dividend paying ETF. One bonus ETF that I will be buying in 2025 is BND. BND tracks bonds from governments, corporations, and even international bonds. I'm still debating how much of my portfolio should go into BND, but I am going to be adding that into my portfolio coming 2025. If you're just getting started and need some help figuring it out, this is what I'm doing. My approach is to split my investments into 5 sections. 4 of them will be made up of ETFs and 1 will be made up of gamble investments. What I'm doing, and maybe if you want to do the same, it will be to pick 1 ETF from each section. 30% of my investments will go to growth stocks. So things like VUG, QQQ, or SCHD. 25% of my investments will be divided into the total market investments. So VTI or SCHB. Another 25% of my investment portfolio will go into the S&P 500 or VOO. 10% I will be investing into dividend paying stocks using my Roth accounts. So things like VTV, BND, JEPI, or SCHD. SCHD being my preferred. 10% will be invested into international markets, individual stocks, or alternatives. So things like SCHF, individual stocks, crypto, art, collections. Nothing really wrong if you invest into multiple ETFs as long as you're investing. If you are not gonna invest because you don't know which ETF to pick, it's better for you, in my opinion, that you invest into multiple ETFs and still be exposed to investments. Make sure you work on balancing your investments once you see your portfolio growing and balance it to a point where it's aligned with your goals. Your focus should be in growing your portfolio and finding ways to optimize your investments. For that, I suggest you watch this video next. It shows you the optimal way to invest your money. It will help you make sense of the investment process and keep you on track to actually getting ahead. Don't forget to like and subscribe. See you in the next video, and let's grow together.